Okay, so we have our next presentation by Mr. Vetri Subramaniam, CIO, UTI Asset Management, Opportunities in the VUCA World. I invite Vetri sir to the stage for giving a presentation, much awaited presentation. Welcome Vetri sir to the 10th Annual Wealth Management Convention 2022.
Great. Good afternoon, everybody. Thank you for being here today. So, what I'm going to do today is just, sort of give you a broad insight into the kind of world that we live in. Some of you may have heard of this term before, VUCA world, but I think it's a good description of certainly the world we live in, but more importantly, it's the reflection of the kind of emotional roller coaster ride that we go through as investors. So to me, VUCA is not just about the VUCA world, but it's actually about the VUCA world of emotions. And Benjamin Graham very famously said many years ago that if there is one thing I have learned after many years in the market, is that it is very hard to understand the market, but it is even harder to understand the minds of investors, right? So I think that's where the VUCA world is perhaps the thing that investors have learned to deal with, to be able to overcome feelings of greed, feelings of fear, if they really want to have a good investment journey, if they want to achieve their financial goals, right? So in that context, this is what I'm going to be talking about. To any of you who are not familiar with the term VUCA, so VUCA stands for volatility, uncertainty, complexity, ambiguity, right? Now, what do we mean by these terms? And I'm not describing the market over here. I'm not talking about market is uncertain, market is volatile. No. We are talking about the world, right? So one very simple way to understand volatility to my mind is really the kind of economic cycles that we have seen literally in the last, it will soon be 3 years. I remember December of 2019 when some people first started to talk about this virus having appeared in Wuhan in China. People said, oh, okay, this is some small supply side disruption in China, who will benefit from it, right? And before you knew it, in 3 months' time, it was a global pandemic, right? Something that none of us thought possible in our lifetimes. We were all locked up at home and told that you can't go out, right? And central banks responded to this sort of a pandemic with the kind of policies we have not seen for, forget 100 years, we have never seen it. They poured liquidity into the system to sort of keep the whole system afloat, and this was something that could not have been anticipated before that event. Then you start fast forwarding few months into the pandemic, and suddenly you start to go from worrying about who will buy my goods to saying people need goods, but there is nobody to supply it. Because consumers started coming out of their houses even before producers could get their factories running, right? That's where you started to encounter supply chain problems, right? So suddenly you went from worrying about life to worrying about supply chains. If you think about the global financial crisis, right from 2010, central bankers' one goal in life has been, let's get some inflation going. They couldn't do it for 13 years. And then suddenly in 2021, before you know it, inflation starts to take off. So just remember, even if you fail unsuccessfully for 13 years, there is still hope for you in the future, right? That is what central bank policy has taught us. So then you get unimaginable, inflation rates. Recently, we saw the central bank governor of Australia apologize to Australians. Anybody seen that? Do you know why he apologized to Australians? Because in 2020 and 21, at multiple forums, he said rates in Australia will not go up till 2024. So he was asked by somebody that people believed you and they took mortgages, and already in 2022 you have raised rates by 300 basis points. So he said, all I can say is I'm sorry. Right? So all I'm trying to tell you is that this is a very unusual world in which cycles just happen very, very fast. Not only do they happen, they are uncertain. We can't predict the future. I mean, who knew about the pandemic? Who knew about supply chain crisis? None of this was, certain. And in the context of uncertainty, I think, somebody put this very nicely. When we think about risk, there are things we don't know, and there are things that we don't know that we don't know. And those are the most dangerous things, right? So that uncertainty of the ability to forecast the future is something that we have to deal with in the investment world. It's also very complex because you can't fully understand the relationships between things that are happening in the world, right? Why should a tanker which blocks the Suez Canal cause a spike in shipping rates, right? One narrow canal where 40% of the world's freight moves through, right? And you suddenly get one more leg to the supply side shock. So on and so forth. It's just unbelievable the way these things are correlated. Many people don't realize, but one of the problems why people were not able to find chips, right? The semiconductor crisis is because to mine bitcoins, you need to put a lot of computing power behind it. So one reason why you could not get chips is that all the chips were going towards Bitcoin mining. And as a result of that, you have a problem somewhere else. Somebody says, I can't get a chip for my car, and my car is, going to be delayed. I hope it's not a chip shortage which has caused that power blackout. So, hopefully that will be back soon. That's as far as complexity is concerned. And finally, ambiguity, right? Ambiguity is where you can't really understand what is connected to what. And this is like a classic example of that. We don't know, where the connections are in terms of ambiguity. We don't know how to interpret something, and we don't know how to, draw the linkages from one point to the other. And that's very true about all the vaccines that we received after COVID hit us. And every time I see some report now about the vaccines, I find that the findings are different from what they were interpreted before. And that's the ambiguity out of how to interpret any statistic. But over there, the late, monarch of England, very sweetly, obviously she is not an economics expert, but in 2009, she was invited to the London School of Economics. And it was power-packed room like this, top British economists. In fact, there were many American economists as well over there. So there were many presentations. I suspect she didn't listen to the presentations. She just showed up at the end for the tea party. And she asked a very simple question about the global financial crisis. She said, why didn't any of you intelligent people see this coming? Right? And nobody had an answer. By the way, many of them tried. I saw, many articles in Wall Street Journal, Financial Times, Economist, where various people who were at that event tried to explain it. But I think her question was relevant, that, if there were so many smart people in the world, how come nobody saw it coming? And I think one reason they didn't see it coming is the kind of world which we live in, where these interpretations, these interrelationships, these connections, the uncertainty and volatility just make forecasting very, very difficult. So in the investing world, because everybody says, what is the forecast? What is going to happen? If there is one thing I have learned in 30 years in investing, and I'm happy to share it on a public forum with you, I'm not saying anything new to you. I have learned one thing. I cannot forecast what will happen in the market. So hopefully one question can be removed from the question queue at the end of the presentation, which is, Agla saal market mein kya hoga? I can answer right now, I have no clue. When I started my career in 1992, I thought I knew what will happen every day. Very soon the market gave me a very costly tuition lesson that forget every day, you will not know what happens on any given month, any given year, right? So how do we deal with this kind of a world? How do we deal with VUCA world? We don't give up and say, oh, I'll do nothing. you can do something about a VUCA world. And these are very, very simple principles. The way to deal with volatility is asset allocation. Don't chase only one asset class. Think about asset allocation. Use different asset classes. The other way to think about, okay, somebody just said 5 minutes, which is another element of uncertainty because somebody sold me 25. So clearly there are missed signals over there. But anyway, I'll try and get done in 5 minutes. The other one is uncertainty. And the way to deal with uncertainty is diversification, right? You don't have to worry about will fuel prices go up, will fuel prices come down. If you have a diversified portfolio, somebody in your portfolio benefits from that, somebody suffers from that. That's fine. As long as those enterprises generate cash flow, have a healthy return on capital, over time they will handle the cycles. So diversification is a great way to take care of the inherent uncertainty in the marketplace. Complexity. Now, complexity is again something which is very difficult to put into, that practical model of how will things interact with each other, but there is a simple way to take care of that. Plan for the future, right? I'm talking here to a room full of people involved in financial management. Make your financial goals and work backwards in terms of what asset allocation, what level of diversification, what level of risk management will allow you to achieve your goals. Once you've done that and you get the planning in place, then you are fine. You don't have to worry about, the complexity which is inherent in the system because your plan will get you there. Finally, ambiguity. This is a more tricky one, right? Because sometimes you don't really know whether factors are cyclical in nature, whether they are structural in nature, and which is why I said one of the things, therefore, any system must have is that it needs to be adaptable. Right? If you're not adaptable, then you will have a problem. So you must have a planning process, but it cannot be rigid. It makes sense sometimes for you to be able to experiment and adapt if the structural arguments demand that you do so. So really for VUCA in the investing world, there is a very simple 4 sort of points I'll make. Have a goal-oriented financial plan, use asset allocation to tackle volatility, use diversification to deal with uncertainty, and because the world is ambiguous, experiment and adapt where required to do so, including, for example, portfolio rebalancing. So that's sort of the simple way to tackle, VUCA. But let's jump on, and I won't spend time on this. This is just an example of, how things change so dramatically in terms of policy rates. You can see over there how policy rates came crashing down in 2020. I talked about the pandemic and the attempt by central banks to pump money in, and then look how rapidly they all start climbing at the end of that period, right? I mean, this is, in my 30-year career, this is the fastest increase in interest rates, not in India, but particularly when you see the developed world and you see the US. So nothing that I've seen in the past could have prepared me for, this kind of increase in rates. Coming a bit to talk about India, just to put an Indian context in place, on a relative basis, India has certainly come out of this very, troublesome equation of the last 3 years in fairly good shape. But my description of India is we are the cleanest shirt in the laundry. You know why I say that? Why does anybody's shirt go to the laundry? Anybody? Because it's dirty, right? There is no country in this world which has come out of the last 3 years untouched. Everybody is damaged. Everybody's shirt is dirty. The only advantage India has is that we are the cleanest shirt among the dirtiest shirts. Right? And I've just shown you the data over there. I'm not saying anything. Look at the data. Inflation December 22 higher than December 19. Repo rate higher than December 19. Industrial growth, that's one good number which is positive compared to negative. Credit growth running much faster, again reasonably good. GSEC 10-year rate significantly higher. GDP growth rate, again linked to that industrial growth, much better. Fiscal deficit, 3.8%. It was supposed to hit 2.5%. Obviously, pandemic happened. Can't stay on the same trajectory. You have to adapt. You have to change. But 6.4%. And now we are talking about 4.5% in 26. That 3.5% target has, the 2.5% target is forgotten for the time being. So it's a challenge over there. Current account deficit, we were running at 1.5%. We are running at almost 3.9% today. So simple point I'm making, I think India is very well placed on a relative basis. It doesn't mean that we are completely trouble free. When you look at that nominal GDP growth from December 19 and December 22, at first glance you will say wonderful, it's up 24% over the last 3 years. The problem is, this is in nominal terms. You remove inflation, it's up barely about 5% in real terms. You adjust for population growth, basically you have had 1% per capita growth in income for 3 years, right? You've still done better than many other countries. The simple point I'm making is that you are the cleanest shirt in the laundry, and therefore it's going to be a lot of hard work in terms of execution for us to achieve the potential that I fully believe we are capable of achieving. But it requires execution to be able to get there. So just in the interest of time, let me jump through. I think just 2 slides I wanted to show to sort of make the point on how to think about asset allocation. One is that when you look at GSEC yields, they have moved up significantly compared to even a year ago. Year ago, the short-term yield was less than 4%. Today, it's sitting, 6.5, 6.75. You can get even if you go 6 months out on the yield curve. So that's a phenomenal increase in yields. And you can see that it's flattened out because as you go higher, it sort of flattens out at 7 quarters, 740. But significant increase in yields in the short term. You look at equity yields. So we are taking the P and inverting it and comparing it to bond yields. This is actually not showing a very favorable equation for equities at this point of time. It's actually pointing to the attractiveness of bonds as a long-term investment right now. So which is why when I look at this sum of indicators from a point of view of how to think about asset allocation, as you all know, asset allocation is important. I'm not suggesting you use this table to time your asset changes. If you can, you're a genius, you're Einstein, go ahead and do it. Most normal human beings can't, right? And I don't claim I have any expertise to rotate as fast as this. Simple principle, stay diversified. But a way to sort of incorporate this in your investing plans is to move from there is no alternative to there are reasonable alternatives. That's what Tina to Tara, right? Not suggesting renaming daughters or wives or, if you can even be bold enough to do that, but from Tina to Tara, right? There are reasonable alternatives, and the way to think about it in fixed income, favorable yields, roll down strategies, long duration, target maturity. Of course, the whole industry is bringing them. We are also bringing them. But I think this is a good opportunity for people to consider. Asset allocation strategies to manage this risk, essentially hybrid funds. The industry runs a range of hybrid schemes, and I think this is also well placed to give you that attractiveness because, you've also got the bond asset class looking quite attractive today. Equities, challenging valuations. But if you are a long-term investor, stay the course with your SIP and STP plans. So that's the way I would put it. Finally, just sum it up over here. Anybody know those 2 cricketers on that photo? Correct. And we both know that they were both equally famous at the point in time where this photo was taken. And everybody said both these guys are going to be superstar cricketers. How many became superstars? 1, right? And the reason for that is what Steve Jobs said over there, right? Ideas are worth nothing unless they are executed. So even when you think about the potential that you have over the next 10 years in India as Indian citizens, I'm not talking about the stock market, as Indian citizens to participate in the growth of the economy, be it as a fund manager, be it as an advisor, be it as a manager, I think it's a great opportunity. You've got to grab it with both hands and make sure you have an execution so that 10 years from now you will not have any regrets that, oh, here was this great opportunity where my country's economy galloped, it grew, but I didn't get the benefit of participating in that. So that's where I'll finally leave it, that execution is everything. But remember those thoughts on the VUCA world. Think long term, do your planning, asset allocation, diversification, and adaptability are really the key to achieve those financial goals over a 10-year, 20-year period. I'll pause over there. Thank you so much for your time today.